The 30-year Treasury yield recently hit its highest level since 2007. Hidden beneath the surface of that single number is the literal price of money. The adult in the room quietly pulled the plug on the party. The UK's 30-year yield climbed to a peak unseen since 1998. Germany hit levels it hasn't touched since 2011, and Japan's 30-year yield is sitting at an all-time high. Yet, in a $2 trillion asset class known as private credit, lenders are selling a completely different story. Even as global interest rates spike, players in this industry insist everything is strictly under control and their loans are perfectly healthy. JP Morgan CEO Jamie Dimon was recently asked about the growing cracks in the credit market. His response was blunt. When you see one cockroach, there are probably more. The raw economic data is flashing severe distress, while the private credit funds report pristine health, because mathematically, those two realities cannot coexist. To trace the plumbing of this crisis, we have to start at the top. The Federal Reserve sets the baseline interest rate for the entire economy. When an entity wants to borrow money, they issue a piece of paper that promises to pay back a fixed amount. In its simplest form, a bond is just an IOU. People bid for that paper. If buyer demand drops, the bond's price falls to attract new money. And when the price drops, the yield rises. They are strictly inversely related. But the immediate pain tearing through the corporate world isn't in long-term 30-year bonds. It's on the short end of the curve, tracked by a metric called the Secured Overnight Financing Rate, or SOFR. Think of SOFR as the overnight receipt for the entire U.S. financial system, based entirely on actual cleared trades. This chart shows the timeline of SOFR. In early 2022, it was effectively zero, but as the Fed aggressively hiked rates, that line surged over 5% by mid-2023. That vertical spike exposed a massive structural vulnerability in private credit. Almost all the debt these middle-market lenders issue is floating rate. That means corporate borrowers' interest payments are directly tied to SOFR. When SOFR rises, the borrower owes more money immediately. Take the software company Pluralsight. They took on over $1 billion in private credit loans. When SOFR was near zero, the math worked. When it spiked, Pluralsight was completely underwater. By August 2024, lenders were forced to step in, inject $275 million of new cash to prevent collapse, and take 85% of the company's equity in return. Standard inflation-fighting adjustments at the top mechanically engineered a suffocating debt trap downstream for thousands of private corporate borrowers. The Fitch default rate for private credit, which tracks hundreds of middle-market borrowers, hit a record 6% earlier this year. Yet the industry continues to act as though there are no missed payments. They achieve this through a loophole called a payment-in-kind feature, or PIK. When a borrower is too broke to pay cash interest, the lender lets them pay in kind. The unpaid interest is simply added straight on to the total principal balance of the loan. Because the unpaid interest rolls into the principal, the loan technically avoids default. The private credit funds then legally report that capitalized unpaid interest as actual income. A large portion of this market operates through business development companies, or BDCs. In exchange for favorable tax treatment, BDCs are legally required to distribute at least 90% of their taxable income back to investors in cash. This forces an absurd outcome. Because BDCs count that unpaid PIK interest as income, they have to mail out real cash dividends to investors based entirely on phantom money they never actually collected from the failing borrower. Across public BDCs, roughly 8 cents of every dollar reported as income is from cash nobody actually paid. For some funds, that number climbs over 14%. The private credit sector is feeling the exact same rate shock as everyone else. They are simply weaponizing sneaky accounting to transform failing loans into the illusion of healthy, income-generating assets. These funds maintain this illusion because their portfolios are categorized as Level 3 assets. There is no public market price to verify. The values are determined entirely by the lender's own subjective internal models. Independent analysis from MSCI recently found that if properly marked to market, over 10% of these private credit loans would already be written down by 50 cents on the dollar. This $85 billion maturity wall maps out exactly when this BDC debt comes due, heavily clustered between 2026 and 2029. When this bloated, pike-inflated debt expires, companies must refinance it all at today's punishingly high interest rates. Wall Street can manipulate accounting lines, roll unpaid interest into the principal, and label a failing borrower as a performing loan. But eventually, the bad math catches up, and the illusion shatters.